This is Brad Harvey. Welcome to our Investing 101 series, Part 1, Establishing the Foundation. This is the first part of a three-part series to try to help you understand some of the intricacies and the processes behind investing. So the first thing we want to talk about is, why are we here? The first question that we get frequently with new clients is, what is the point of investing? The goal ultimately is to protect and grow your wealth. How do we do that? Well, there are lots of complicated processes that are involved, and we want to demystify those. There can be a language to this. There can be lots of different concepts. We want to make that easy to understand on a fundamental level. Initially, there are two phases of investing. There's the accumulation phase, and then there's the access phase, or growth and income. The other thing that we want to talk about as we get into this is the law of supply and demand. The law of supply and demand when it comes to investing is probably the most important concept to understand. And we will also be talking about macro definitions, which is big picture, and micro definitions, which is small picture. So let's start with basic investment strategy. The most important law that you hear about all the time, and it's a little cliche to be honest, is buy low and sell high. Now, I will tell you this sounds easy on paper, but it can be incredibly difficult because when things are selling off and they are low in the markets, no matter what asset class we're talking about, the emotion tells you, oh, I'm scared. The value could go to zero, but yet the price is low. So people like me are going in and saying, hey, we need to be aggressively looking to buy certain securities because they're a whole lot cheaper. And the flip side is also difficult because selling high can also be an emotional response. If you bought something that was at $100 and now it's at $150, you've made a 50% gain and you're thinking to yourself, hey, it might go to 200, but yet it's high. We've made the return that we were trying to make, we've reevaluated, and it's time to sell. So we bought low and we sold high, but that can be a little bit counterintuitive. So we frequently get the question, how do we know if things are low or high? That's when we start to look at indicators. There are lots and lots of different things that we can look at to determine appropriate valuation of investments. They're certainly not perfect, but we start out at the individual company level. So we talk about basic asset classes, and I'm going to go into definitions in just a second, but we want to look at these indicators first at the individual company level. Are they making money? Are they not making money? Are they growing their earnings over time or not? And then there are also market level indicators. These are indexes. Indexes like the Standard & Poor's 500, which is just an index by the Standard & Poor's Media Company of 500 large companies in the US, so that they have some idea of what the total valuation of the market is. And then we also have asset allocation that we want to discuss. Asset allocation is very simply what percentage of your investments are in which assets. So let's talk about some definitions. So one of the first definitions that we should look at are stocks. What are stocks? Stocks are simply ownership of companies. So instead of having a closely held business like a local car wash or a dry cleaner, we're talking about typically bigger companies that might have a presence throughout the US or even globally. These are larger companies typically, and these stocks trade on the stock markets. So the owners of those companies can be anyone that wants to put in the money. It's not limited to family members or executives. They're publicly held. Now, there are certain rules that go along with that. There's public information on their earnings and their expenses and how they're operating and what they do. That information is available to the public because they're publicly held, so they have to follow those rules. A bond, very simply, is a debt instrument. It's a loan. So if the federal government is loaning money to people, that's a bond. They issue a bond for those bond holders, and those bonds typically have a maturity date. Maybe they're out 10 years or 20 years, and they'll have a fixed rate of interest. Maybe that interest rate is 2%, so it pays you 2% per year in interest, and then in 10 years you get your principal dollars back. There are other things that are investing that we should talk about from a conceptual or definition standpoint. There are commodities. What are commodities? These are things that come out of the ground. Things like crops, agricultural products, corn, wheat, soybeans, also cattle, pork, chicken, also energy like oil and gas or coal, or precious metals like gold and silver. These are commodities. Okay, so how do we access these investments? Well, one of the most common ways is through a mutual fund. And a mutual fund is just simply a collection of investors who have pooled their money. That money then will invest in stocks, bonds, or commodities, whatever the fund is designed to invest in, and it's managed for you over time. Sometimes that manager might be a computer, if that mutual fund only tracks an index. Sometimes it can be a person, or sometimes it can be a committee. But the key point here is it's a pooled investment of other investors with you, and the decisions day to day on what to buy and sell do not rest with the shareholder, they rest with the manager of that fund. Another definition that we should talk about are REITs, R-E-I-T-S. They're real estate investment trusts. These are typically set up like mutual funds, and they are companies that just own real estate. Now, that real estate can be office properties or retail properties or residential like apartment buildings. Those REITs also trade publicly, so you can buy them and sell them quite easily. As a caveat here, there are some non-traded REITs which I would not recommend because they can be very difficult to sell or to value over time. The last definition that I want to talk about are the stock markets. So what are stock markets? This is very simply a place where you go to buy and sell securities. It's an auction house, nothing more. So if you have somebody who wants to sell a company, let's say they own shares of IBM, and they say, wow, I need to get liquidity. I need to sell that and get money for it. Well, just like selling a car or house, you have to find a buyer. The stock markets, quite simply, are just a place where those buyers and sellers can come together, and they'll say, okay, I want to sell my IBM. It's currently trading at $100 a share. I'm willing to sell it at $100 a share if somebody's willing to pay that. If there isn't somebody there willing to pay it, then the price will fall until we find somebody who will pay for it. The reverse is also true. If you want to buy IBM and you can't find somebody who's going to sell it to you, you typically will increase your bid for that, so the price will subsequently go up. It really is that simple. Yes, there's a lot of media coverage, there are a lot of indexes that go out there to talk about where the market is or isn't, but it simply is just telling you where is the price at that particular point in time. And if we take the price changes for 500 companies, then it gives us some idea of the trend of the stock markets. Also true in the bond markets. These can be publicly traded, so you don't have to wait for a bond to mature in order for you to sell it. Another definition that we should talk about is inflation. Inflation is a very important concept to understand over time because it can erode your purchasing power. What is inflation? Inflation is very simply the amount of price rise that happens for things that we consume on a regular basis. The government put together what they call the CPI. The CPI is the Consumer Price Index, and all it is a basket of goods, and periodically they go out and check the price of those goods. What are those goods? It can be a gallon of gas. It can be a gallon of milk. It can be what you're paying for electricity or rent or transportation or clothing and education. All of those things feed into the Consumer Price Index because we want to be able to track the change in price over time. A good inflation rate to assume is 2.5% to 3%. That's about the range that it's been in for quite some time. Certainly we've seen times much higher. In the 70s and early 80s, inflation got over 10%. So prices were going up by over 10% per year. Now, interestingly enough, as a side note, inflation is not necessarily all bad. Inflation can actually stimulate spending. Remember, we talked a little bit about supply and demand. Well, if we have more demand for things than we have supply, prices will go up. Well, that means that the companies that are producing those goods, their earnings go up in terms of dollars. Now, their prices might be going up as well, so their net earnings after inflation may not be changing much, but it's very important to keep track of that. So as we're planning for future cash flows, we're planning for retirement, we need to make sure that we are projecting out what our spending will be after we take out the impact of inflation. So if we're planning on getting $100,000 a year in retirement income in today's dollars, but we don't need that for 20 years. Well, $100,000 a year, 20 years from now, will not buy the same amount of goods that it will today. So that's inflation. So that takes care of the basic definitions. Let's now talk about basic strategy. Now, the stock markets over time have certainly been pretty volatile, and we want to make sure that we keep track of our estimates of returns. So as we're putting together our asset allocation, which is the percentage that we put into different types of investments, we want to make sure that we're using good assumptions as we put together that mix. Now, a good rule of thumb is, over time, stocks have averaged about 10% per year. Now, that's a 100-year average, and these are basic averages. Bonds have averaged somewhere around 5% per year. Treasuries have been around 3% per year, and inflation is about 2.5%. I know that's a lot of numbers, but you want to feed that through. So if you have to get a 10% rate of return, well, then you're going to have to put 100% of your money in the stock market. I obviously don't recommend that, but if that's the required rate of return, you're going to have to take some risk. Now, we will talk about risk in more detail coming up. In asset allocation, what is important to understand is we're trying to manage risk, which is volatility, how much our prices go up and down over time, versus our expected return. So we use what's called a hook chart to demonstrate this graphically. And what it really shows you is 100% bonds, which are considered to be a lower risk asset than stocks, does not actually get you the lowest risk portfolio. Why? Because interest rates change over time. And so we also want to understand that 100% stocks is not necessarily going to be the right mix if we're trying to manage risk versus return. The hook chart also shows us that kind of the biggest bang for buck, if you're trying to minimize your risk and get the most return for the risk that you're taking, we actually need about 20% exposure in stocks. And I know that can be counterintuitive, but it's very important to understand that mix in your asset allocation over time. So the last piece of this before we move on to Unit 2 is to understand that change is inherent in this. We must be monitoring our investments over time and making adjustments or rebalancing based on our goals. Have those changed? Has our time frame changed? Has the investment environment changed? If the market is down 50%, well, then maybe it's time we add some exposure to the markets, the stock markets, because that represents a lower risk overall than it was before it lost 50%. Again, I know that's counterintuitive, and the emotional response can certainly cloud that. But getting to our goals, no matter what that goal is, we want to stay focused on that. We want to make sure we're taking progress toward that, and we understand there will be obstacles that are thrown up in the process. So this is Brad Harvey with Harvey Investment Management. Thank you for listening in to Investment 101 Part 1. Stay tuned, we've got Parts 2 and 3 coming as well.